this is Bryan Rich from Money and Markets TV. Next month, the Federal Reserve will be winding down its second round of quantitative easing. But recent history suggests that round 3 may not be out of the question. Just think back to last August. The latest economic reports were dismal. All hopes of a sharp economic recovery had evaporated, and the signs pointed toward deflation and a double-dip recession. That's when Fed Chairman Ben Bernanke said he was willing to do whatever was necessary to manufacture economic growth. That signaled to speculators that QE2 was coming, and the expectation of easy money induced them to make leverage bets on stocks and commodities. That pushed those markets higher, which made companies feel a little more financially stable and a little more wealthy, and in turn boosted the jobs data a bit. But now QE2 is coming to an end, and with it, the illusion of strong economic recovery. For proof, let's take a look at the GDP forecasts. At the beginning of the year, many economists were projecting growth to be as high as 5%. The Fed was thinking 3.4 to 3.9%, above average for the US economy. But now, private forecasters are predicting 2.7% growth. And the Fed just downgraded its estimate to around 3%. But even those numbers are probably way too optimistic. That's because severe financial crises, like the one we experienced in 2007, 2008, don't happen overnight. They're preceded by a decade-long buildup of credit, usually, and followed by an unwinding of all of that debt, which also takes about the same amount of time, 10 years. And according to Carmen Reinhart, who co-authored the most extensive study ever done on historical global financial crises, growth during the decade following the crisis tends to be at lower levels than pre-crisis growth. And there's evidence that that will be the case this time as well. In April, the Bureau of Economic Analysis estimated that the final reading for the first quarter of GDP growth will come in at just 1.8%, well below the 3% long-run average. And that's a very bad sign for the US economy. There's a recent Bloomberg study that suggests that since 1948, whenever GDP falls below 2%, a recession normally follows. Carmen Reinhart also said that following a financial crisis, unemployment will hover around 5% higher than pre-crisis levels. And that's exactly what we're seeing now. Even after 2 rounds of quantitative easing by the Fed and 2 rounds of fiscal stimulus by the government, 9% of Americans are still out of work, much higher than the long-run natural rate of unemployment. Third, Reinhart predicted that housing prices will remain anywhere from 20 to 50% below peak levels. And once again, she's right. The government has recapitalized the banks, the Fed has kept mortgage rates historically low, and various failed mortgage programs have been floated. Yet still, the Case-Shiller Housing Index shows home prices 32% off of their 2006 highs. So how long can we expect this deleveraging phase to last? Well, look at the US consumer credit may provide the answer. As you can see, the credit boom took a decade to build, peaking in 2008 when Lehman Brothers failed. Since all that debt will take about as long to unwind, the world can probably expect another 7 years of this economic malaise. Ben Bernanke knows this, and it's why he's been so persistent about maintaining the Fed's easy money policies in the face of so much criticism. But despite his efforts, we're likely to see another violent downturn coming in the global economy. I'm Bryan Rich from Money and Markets TV. Thanks for watching.